Pranjul, hi, good morning. Good to have you on the show. Pranjul, majority are expecting a status quo once again in the rates as well as the stance. What is your own view and what is it that you're going to be particularly looking out for from the commentary this time?
Yeah, so I think, we have the same view that there won't be any big change in monetary policy this time. The RBI will be sitting tight. So there won't be any change in rates. There won't be any change in liquidity stance. There will be no change in their accommodative stance that they've held on to over the last year. So no change as such. The one small change that we think that could happen is that RBI will probably sound more cautious about inflation than they were sounding in the previous meeting. And they may also bump up their forecasts. Currently for the fiscal year at 5.1, they may take it closer to 5.4 or something like that. For the simple reason that we are seeing a lot of inflationary pressures in the economy, which has now reached a point where it can't be really ignored. So that's one big change that we think we'll see, and the bond markets could react to that on the margin. The other thing that I would be looking out for and maybe asking the RBI to give more information on is its liquidity policy. In previous monetary policy cycles, we used to think a lot about rates, repo rate, reverse repo rate. We used to not think so much about liquidity. But this time, because the RBI has infused so much liquidity, and right now the system has about 11 trillion rupees of liquidity, which is extremely large, there has to be some thinking about what is RBI's attitude to liquidity going to be. So far, they've been buying dollars, they've been buying bonds to keep the 10-year from going up. But if they continue to do that, they're only going to flush the system with liquidity at a time when inflation seems to be pretty high. So their strategy on liquidity is something, I would want to really hear from the RBI in tomorrow's meeting.
That's quite interesting, Pranjul. You've given us a whole host of points to talk about. But first things first, do you think the RBI's focus is going to continue to be growth as opposed to inflation?
That's the million-dollar question. And I think, look, it can't completely suddenly change its stance. Over the last year, it has been more focused on growth over inflation. That is no big secret. Over time, I think they will slowly try on the margin, try to move attention from growth to inflation, because that's the call of the day. But they can't do it very quickly, very sharply, because that could disrupt markets and it could also hurt the economic rebound that we are seeing. Look, the truth is that there's both good and bad news on growth. The good news is that the direct cost of every subsequent wave is turning out to be lower than the previous wave. And that is something we are seeing around the world. There are many reasons. Maybe consumers and firms are learning how to live with this pandemic. But the bad news is that there is a lot of uncertainty in the system. We are worried about a third wave. We are worried about high prices and how they are hurting corporate margins. We are worried about the fall in sentiments. So there are a lot of problems. And of course, then there are all the scars that the pandemic could leave behind. Inequality, 80% of informal labor force could see a fall in demand, health of banks. So there are a lot of concerns still. So they'll have to just balance it out.
Pranjul, just one more question that I want to get your view on is specifically on inflation. A lot of commentary has come in over the past several months. Core inflation is persistently high. Is there a sort of a divergence in how a lot of people are looking at the persistence of inflation and the way that the RBI Monetary Policy Committee has so far dealt with it, in that their view should essentially be to bring it lower, and to that end they should have done something on liquidity or they should have done something on rates so far. So is there a worry that that could play out in the rates of the bond market?
Look, inflationary pressures can't be ignored. For 21 months, inflation has been higher than the 4% target. For half of that period, it has actually even been higher than the 6% upper limit. At every point, the dominant narrative is that, look, there is this inflation driver, but it is temporary, it will go away. The problem is that we are seeing a series of these temporary drivers, from logistical disruption to pent-up demand-led inflation to cost push-led inflation. There's a new driver coming in every 1 or 2 months. inflation is a problem. In fact, going forward, I'll be probably looking at two things that I worry about. Number one, cost push inflation. Global prices have increased. We've seen particularly small firms haven't really passed on all of these high prices to consumers. They've taken it on their bottom line, on their margins, but there's only so long that they can deal with taking it on their margins. As soon as demand picks up a little bit, they may become more aggressive about passing it on to consumers, and that could be inflationary. The second is the inflation cost of inequality. We know inequality has risen. Large firms have become larger. The rich have become richer. As pricing power of large firms increases, that could become more inflationary. We know that individuals who are richer tend to consume more services. As they get vaccinated, they will demand a lot of services. Service inflation could increase. So there are a lot of drivers for inflation in the system, which the RBI cannot ignore. Over the last year, they have been flexible about inflation. It is a flexible inflation targeting regime, so it's fine. But going forward, if they keep away from the 4% target, or if the market perception becomes that the RBI doesn't care about the 4% inflation target, then there will be a cost to pay. So our sense is that we will start seeing a gradual policy normalization, perhaps not tomorrow, but definitely by the end of the year, in the October to December quarter of 2021.
Absolutely. Thanks so much, Pranjul, for laying the context out. Lots to look forward to tomorrow. Pleasure speaking to you as always. As we slip into this short break, we're down on the Nifty 50 by about 0.2%. Be back really soon.